Hi, this is Stephen Ware with Storage Syndicated Equities, and I'll be covering in this video a quick overview of our Sandusky Storage Units offering. This is a 506B syndication, so you have to have a pre-existing substantive relationship with us, regardless if you're accredited or non-accredited. It's going to be about 15 minutes long. We're going to do a blazing fast review of this investor deck. We suggest and request that you go ahead and read through this deck thoroughly. Especially if you have any questions, please do not hesitate to reach out, but also go ahead and reach out to your financial and legal advisors as well. All investments carry risk. This one is not any different. What does make this thing different is that it's a wonderful deal that we're very excited about. So Sandusky Storage Units is located in Sandusky, Ohio. On this front page here, you can see that the closing is December 28th, 2023. So this is a great fit for any investors that are looking for some last minute tax savings for a wonderful 2023, as well as a great return. As you can see here, we're going to be raising over $1.5 million, and we are projecting a 1.8 to 2x equity multiple, a 14 to 16% internal rate of return, and an 18 to 20% average annualized return. Please read through the disclaimer. So to summarize, this is an institutional size self-storage facility. That's why we have identified it as a great opportunity. Currently, it is 48,465 net rentable square feet. It's a single-story drive-up that has a variety of different units. So it has interior access temperature-controlled units. It has drive-up self-storage exterior access. It has contractor units, maxi storage, outdoor parking. It is fully fenced with a keypad and gate, and it's fully occupied. So it was 100% occupied when we approached the seller. And because there is a construction element to this deal, I should say conversion element of this deal, we actually got him to start some of the legwork by vacating out some of the spaces that we were going to be optimizing, changing it from warehouse space or office space into additional units. Sandusky, Ohio is a great market. It's got 47,000 residents. This facility, as we'll see on the next page here, has pretty much all of Sandusky as part of its trade area. In this photo right here, the second one down in the right column, you can see that the 5-minute drive time is the red area, 10-minute is the green, and the blue is the 15-minute drive area. So pretty much all of the dense residential part of Sandusky is part of the trade area for this facility. There is land to expand on here, which is part of the value add that we are doing. We are thrilled that the value add has already started to take place. So behind this large white building at the top of the lot, there's actually additional portable units that we've already had erected, and they're already renting out. So in our projections, we don't have these units being ready to rent for another 6 months, and we already have them up and getting rented. So it's great news and will accelerate our projections. They've put units behind the building here. There are also going to be units, well, there are units along this fence line here. There are also units along the grass area here. And then there is a row of units that are behind the maxi storage where this little boat and trailer are, if you can see my mouse on the screen. The opportunity can be broken down into 4 different elements. The first one is an advantage purchase. We were able to reduce our overall interest rate by having the seller do a 4% interest, $800,000 second position seller carry. We're going to be purchasing this facility at less than replacement cost. As I mentioned, it was 100% occupied until we already had some of the spaces that we're going to be changing start to get vacated. So right now, I think it's somewhere around 85% occupancy. The soft value add, it's currently at 69% economic occupancy because there's a great differential between the oldest renting tenants versus the newer renting tenants. So amongst the same unit size, there's a great variety of rental rates. So even if we just standardize the rental rates at the existing highest current rental, there is going to be about 31% meat on the bone just from that. And these rates are already slightly below market to begin with too. We're going to be improving the search engine optimization and the marketing of this facility. Then there is a hard value add element that is addressing all the deferred maintenance, improving the aesthetics of the facility. We're converting the largest warehouse into a new office because the existing office is inside the fence and gate. So we want the office to be on the outside of the fence and gate. So we'll have some temperature controlled units in the old office space, and then we'll have some convenience units in the newly built out warehouse space. And through all of these hard value add, we'll be able to improve this from a Class C to a Class B facility. So that'll compress the cap rate. And then the kicker is that we actually own 2 other self-storage facilities outside of this syndication that are in Ohio that have timelines that will most likely link up with this self-storage facility. So there may be the opportunity for a symbiotic portfolio sale, which would further compress the cap rate on this facility for either refinance or sale. Here we can see the finances. So the total project cost is $4.3 million, slightly above. You can see how that breaks down on the right-hand side here. So we're going to be getting the $800,000 second position seller carry. And then in Q1 of 2024, we're going to be getting a little over $1.9 million in bank debt. That bank debt will be for the $1.59 in construction, as well as the remaining $350,000 of the purchase price. So a little bit of an interesting structure, but it really makes a huge difference in how viable and profitable this deal is. So we're thrilled that it's working out this way. So just to summarize one more time, since I know it's not typical, we're doing a 2-stage closing. The first closing will be end of December. That's for $1.15 million. Then in Q1 of 2024, we'll be closing the construction debt. So that will be inclusive of the $1.59 million needed for the construction portion of the project, as well as the remaining $350,000 of the purchase price to seller. So the seller is getting a total of $1.5 million now, $800,000 being carried on top of that. So total acquisition price is $2.3 million. And then we're having the bank debt for the construction, as well as we're raising additional funds for the fees, expense reimbursement, and closing costs, because we've done a fair amount of legwork prior to closing here. You can see how the annual income and expenses shake out over the first 5 years here. So we're going to be able to keep the expenses relatively low, but steadily increase the income with stabilizing the rental rates, standardizing the rental rates, I should say, and then also bringing on the new units between the temperature controlled as well as the drive up portable units that we've put in. And this is poised to be very attractive for banks just because A, we're going to be doing a lot of stabilization before even getting the debt for the construction element, but also it's all coming together to be less than 75% loan to cost. So keeping it very conservative with the amount of leverage that we're seeking. You can see the year-by-year financials in detail here. Just some quick conservative assumptions that we want to draw attention to. So our construction team says that the construction, which is all the deferred maintenance, the demo and build out of the large warehouse into convenience units in the new office, and then converting the old office into additional temperature controlled units, as well as there is a smaller warehouse that's going to be converted into some additional interior access units. Our construction team says that can be done within 12 weeks of closing the construction loan. Now, we want to be more conservative than that, so we have estimated 6 months. Part of that 6 months of construction was putting up the portables, and that's already done. So we're ahead of schedule already. We haven't even closed. Other conservative elements of our projections are we are assuming a 2.3% per month lease up of the new units. We have other Ohio projects that are leasing up far higher than this at 3.5%. We're assuming a 3.5% income increase per year. We all know that inflation is far higher than that. So having it be greater than 3.5% interest is kind of par for the course. And then the national average stabilized occupancy is 93.4%. This facility historically has been floating between 97 and 100% occupancy. So we are projecting far lower than the historical occupancy and even lower than the national average at 92%. You can see that by end of year 2, we're at 1.2 DSCR. So banks will love that. We have a very high debt yield percentage. So that's also awesome. And then we actually start to have some cash on cash return on investment, even with the construction loan element by end of year 2. And we also project that we're going to be at stabilized occupancy by end of year 2 as well. And then by the time it gets to end of year 5, we've got some great cap rates internally, great debt service coverage ratio as well, great debt yield, and we'll be poised for a wonderful valuation. So the first thing that we're going to be doing is the rental rate standardization. So the facility is currently at 69% economic occupancy. Even if we just standardize the rental rates at the current highest rental rate per unit size, it is a 44% increase. Once we're done with the post expansion of adding the temperature controlled units as well as the drive up units getting leased up, we'll be at a gross rental income potential of $10.12 per square foot. And you can see how that makes a big difference in the total gross potential rental income, jumping from the current $391,000 up to $604,000 by end of year 5. For marketing optimization, the second part of our soft value add, we're going to be changing the name from our self-storage to Sandusky Storage Units. We've already purchased SanduskyStorageUnits.com. We're going to be improving the keywords mapping and functionality of the website because our self-storage actually currently does use Storage's website design. It's fine. It's just not particularly good and it hasn't been optimized. So we look forward to doing that as well as with Google My Business and other listing sites. This is also going to be part of our retail brand of social self-storage, which does have a charitable commitment. We're going to be giving back to the community, and that certainly does not hurt us in terms of getting the name out there and improving the occupancy. And then we're going to be improving the curb appeal of the property with paint, new signage, and repaired siding and new asphalt. So this addresses the 74% of renter sources, which is the drive-by, where people are physically seeing the property. That's 30.2% of where you get renters from, is physically seeing the property in the curb appeal. And then 43.8% of renters find self-storage facilities online, and we're also going to be improving that as well. The construction element is to address the deferred maintenance. I mean, it's in good condition right now, but it's a Class C facility. We love Class C. Class C stands for cash in our minds. So we are going to be looking forward to addressing all of those maintenance items, as well as doing the things I mentioned of building out the warehouse, changing the office, temperature controlled units, and the portables. And you can see how this all kind of shakes out. It takes us from 48,465 net rentable square feet to 54,937 net rentable square feet. It brings the drive up units from 157 to 166. You'd think that it'd be more than that, but we're actually getting rid of some of the old drive up units. And I do drive up units in quotations just because I'll show you a picture in the next slide. It's actually internal to the warehouse, but there is a drive-through lane, but they're terrible wooden box units. Temperature controlled units is where the majority of addition of new units is going to be because the market doesn't have a ton of those, and those seem to be in very high demand. We're going to be reducing the amount of RV and boat parking spots just because those are not optimized rent per square foot type units. And this brings total units from 262 to 339. And all of these things are going to be bringing it to a Class B facility that will have an improved market cap rate for sale or refinance. So you can see in the upper right-hand corner here, these are what those wooden kind of units are in the large warehouse. So we're going to be demoing out the first floor, putting in the drive-through lane, having the new office in there, and having some convenience units in there. We're going to be relocating and building out a new office that's attached to the convenience units. We're converting the old office into temperature controlled units. We're going to be renting out those additional drive-up units that we've already put out there. So there's already 4,320 net rentable square feet of drive-up non-temperature controlled units that have already been erected and started to rent it out. And then we're going to be doing all the maintenance and repair stuff of new asphalt, new roofs, new siding, new signage, paint, gate upgrades, etc. So in summary of the deal, the total project cost, fees and everything included is $4.3 million. And then the projected sales price is slightly above $5.6 million. And that's at a 7.25% cap rate. If we include it in a portfolio or if interest rates improve, that cap rate will improve as well. And this facility will be worth even more potentially. We think that even if interest rates rise a little bit more, 7.25 is still a very conservative valuation for this facility. It's going to be freshly rehabbed. It's going to be above 50,000 net rentable in a great market. So revenue is going to jump up. Operating expenses we can keep relatively low here, and then net operating income is going to be significantly higher with stabilized end of year 5. So here's a cap rate matrix of sales. So this kind of gives a range of what the potential valuations could be. So at the highest, we think that it would trade for 6.7, and at the lowest valuation, we think it would trade for a 7.75% cap rate, with that 7.25% cap rate in the middle there. And we think that's probably the most likely. To bring attention once again to our conservative underwriting, because we are a under promise, over deliver organization. The 2.3% absorption assumption is 30% lower than our other Ohio projects. The 3.5% income increase that we used as an assumption is far below inflation. 92% max occupancy is not only below the national average of 93.4% occupancy, but this facility has historically floated between 97% and 100% occupancy. For the Q1 construction loan, we are using assumptions like 8.5% interest and a 1.35 debt service coverage ratio requirement by end of year 3. Our projections are able to achieve both those things, and we already have term sheets that are showing rates at 8.5%, if not lower. The two-stage closing is going to allow us to capture an 80% bonus depreciation in 2023 for the acquisition, and then the 60% bonus depreciation capture for 2024 for the construction element. As I mentioned, we're already ahead of schedule for the lease up of the portable units, and we look forward to I don't know what I'm saying. I look forward to having this over the moon. I don't know. This is the equity investor's opportunity here, just summarize. So once again, this is a Reg D 506B. So you have to have a pre-existing substantive relationship with us. If you're viewing this, you should already have that. But if you don't have a pre-existing substantive relationship with us, then this investment is not for you. But if you are a accredited or non-accredited investor with a substantive pre-existing relationship with us, then this may be a great fit for you. Money needs to be wired in before December 28th. This is a 5-year hold. We're projecting 40 cents on the dollar for depreciation for 2023, and then another 27 cents on the dollar target depreciation for 2024. So this could be a great fit if you have some taxes that you need to be working through. Minimum investment's $50,000. Total raise amount is slightly over $1.5 million. And our projections result in a equity multiple of 1.8 to 2x, a internal rate of return projection of 14 to 16%, and a projected average annualized return of 18 to 20%. This is how it all shakes out in terms of actual dollars and cents. You can see at the top row there that if you invest $50,000, if you go down the line, you can see all of the various results here for the tax offset for 2023, the estimated tax offset for 2024, your total distributions, the return of your capital, and what the net proceeds and your equity multiple would be. So the tax offset's kind of the cherry and whipped cream on top, because that's not necessarily included in your distribution. So that's just a bonus. The rest of this deck, it's about the industry. If you're watching this, you probably have thought about investing in self-storage. We think that's a great start. We think that actually acting on it is probably in your best interest, partially because the average annual total return by REIT sectors has been led by self-storage. Self-storage is the number one total return by REIT sector. You can see that the S&P 500, for comparison, was at 10.8 from 1994 to 2021, while self-storage is 18.8. The next highest total return by a REIT sector is industrial, and that's 3% lower than self-storage. If you were to put this in actual dollars and cents, the 2021 value of $100,000 invested in 1994 would be 1.6 million-ish for S&P 500. In comparison, it would be over $10 million if you had invested in self-storage, $100,000 back in 1994. One of the great opportunities of self-storage is its usage. Only 1 in 10 households rent self-storage currently. Now, this is a criticism often, but it's actually an opportunity. The criticism is that, multifamily, you need it. Somebody needs a house. They need a roof over their heads. Self-storage, that's a luxury. You don't necessarily need it. But the mentality around self-storage is changing amongst the public. And you can see that it's been steadily increasing from 2005 to 2020. There was a slight dip towards 2013, but it's been chugging along ever since. And it's always maintained since 2005 above 9%, it looks like. If this goes from 1 in 10 households to 2 in 10 households, all of a sudden the demand has doubled and our industry is scrambling to provide more supply. The mentality has changed from a luxury to a necessity amongst the boomer populations and amongst millennials because there's downsizing occurring. You have millennials that are either buying smaller houses or renting smaller houses, and they're using self-storage as kind of the secondary space for all of their toys and travel belongings. For boomers, we're approaching the silver tsunami. So you have a lot of people that are downsizing or they're having vacation homes, and so they use self-storage to facilitate that sort of lifestyle. Additionally, if we have people going into assisted living or retirement communities, a lot of those communities actually require self-storage. So we project that this is going to continue to rise. Self-storage is not without challenges. Those challenges are recession, scarcity, saturation, fragmentation. Now, every sort of investment vehicle has a recession as a challenge. But self-storage has an interesting two-sided coin between scarcity and saturation. You think those are almost opposites, but they're actually the same coin, two sides. Scarcity, there's only around 60,000 self-storage facilities in the United States. So if you're interested in buying a self-storage facility, they are in high demand and low supply. The saturation comes from market to market. All of the REITs traditionally have been focusing on primary markets, densely urban areas, where now the supply is sky high because it's just been a land grab where they've got a 30-year horizon on their money and they've got to spend their money. Otherwise, their shareholders are not too happy with them. We primarily operate in secondary and tertiary markets. That's one of the ways that we get around the whole saturation side of things. So while there is a scarcity, a lot of those self-storage facilities that exist are oversaturated in primary markets, The fragmentation is fragmentation of ownership. About 65% of facilities are owned by self-storage operators that have less than 2 facilities each, mom and pop operators, if you will. So unfortunately, it's not as easy as finding people that have these huge portfolios that are willing to sell to you off market. The people that have the larger portfolios are usually the larger players. So by 2010, developers had stopped building. This is why we are very bullish right now, because by 2016, prices skyrocketed as a result of low inventory and high demand. REITs are incentivized to acquire per their shareholders. So while REITs may be on the sidelines right now, and builders and acquisition firms may be holding their pearls and clutching their pocketbooks, waiting for a little bit more certainty in the debt market, or just something to tell them, hey, there's a light at the end of the tunnel of this economic uncertainty. We are plowing through. We are continuing to move forward smartly, structuring things in advantageous ways so that we have downside mitigation at the heart of all of our investment decisions. Our solutions are multifold. We have the recession resilience that is intrinsic to self-storage. While other real estate assets dropped in value during the last recession, 2007 to 2009, self-storage also dropped, but it was the lowest of any real estate asset class. It dropped by negative 3.8% in comparison to the S&P 500's negative 22%. So that's compared to the stock market as opposed to REITs. For instance, during the pandemic, there were 1,700 CMBS loans made to self-storage in the first 3 quarters of 2020. Only 3 were delinquent. Multifamily was 18 times that rate. We are able to overcome the scarcity challenge because we have built a marketing platform. And a platform beats a pipeline because it allows for consistent flow that isn't directly reliant upon us spending marketing dollars and instead can be supplemented through traditional marketing avenues. We have addressed the scarcity and the fragmentation challenges through our consolidation and portfolio strategy. We have experience in gathering facilities together and then going ahead and putting them out to market at a compressed cap rate, which has resulted in over a 20% valuation premium. The case for our consolidation strategy is seen by some of the larger guys out there. So Blackstone, just recently had a sale to Public Storage. Extra Space bought Life Storage, all for huge dollar amounts. We're talking about $181 per square foot for the Life Storage acquisition, and we're talking about $244 per net rentable square foot for the Blackstone sale to Public Storage for their Simply Self-Storage brand. This is what we do. We've talked about it slightly in this presentation, as well as if you're familiar with us, you may be well accustomed to our strategies and activities. We use a marketing platform versus a pipeline. We incorporate multiple underwriting redundancies for downside mitigation. We do creative deal structuring for downside mitigation. We have conservative contract creation for downside mitigation. We've surrounded ourselves with the leading service providers for premium operations, and then we pursue opportunistic capitalization options through sale and refinance and all the various options within those two categories of sale and refinance, whether it be at entitlement, certificate of occupancy, stabilization, and then multiple different avenues of how we are disposing of the property, whether it be a single asset exit, a congregation exit, master lease, fund-to-fund handoff, et cetera. We have some case studies here. This is of a value add self-storage facility that we did in Alabama. Our investors on this one were quite happy. You can see our target metrics versus what the realized metrics are. This is just an example of our under-promise, over-deliver mentality. Same thing with this. This was one of our development deals. This was Mokina Self-Storage. So this was ground-up development. You can see our target metrics versus the realized metrics here. Once again, happy investors. Here's the team. And this is a team that we've assembled using a hub and spoke model to keep our operating costs low. But every single one of our team members embodies our core values of altruism, commitment, and ethics. ACE is how we remember it. This is our fearless leader, Fernando Angelucci. He'll be the one that's answering any sort of questions you have on this deal, and he'll be calling you, or you'll be calling him, I should say. You'll be calling him in beautiful, sunny Sao Paulo, Brazil right now. He is south of the border. This is our retail brand, Social Self-Storage. Self-storage, I mean, it's beautifully simple. It's metal boxes. To me, brings a tear to my eye. But to the average renter out there, it's basically about convenience and security. Are you located near me? Is it easy for me to get into my units? And are my belongings going to be kept safe? We decided to add an additional differentiator there by making us more than just metal boxes. We want to have it so that we're taking advantage of the fact that self-storage is a hyper-localized business. We're able to give back to the communities and really leave our fingerprints on a community in a positive way. The reason that we've been so successful is because we have the ability and the experience to operate in all market sizes. So while some organizations are these giant battleships that are hard to move around and not as agile, we are able to perform and operate in any market size, and this results in deals at drastic discounts, quicker value add, and greater downside mitigation. You can see our track record. It speaks for itself. In a short period of time, we've done over $200 million in transaction volume. We've had our hands on quite a number of self-storage facilities, and we're continually growing, and we have experience in our portfolio strategy as well. If you have any questions, please reach out to Fernando. His contact information is on this page. We can also respond to the email that you most likely got about this deal. We look forward to hearing from you, and we hope that you can join us in investing in this wonderful opportunity. Thanks so much.